All right, so today we're going to be talking about the game, level 2 understanding, and the theme is going to be conflicts of interest, which is a big topic in this industry on many different levels. So the idea of this lesson is to really understand what are the moving parts behind the scenes, where does the money flow to? Because ultimately, if you understand who's making the money, how they make their money in this industry, you understand where the incentives lie for each party or each player. And there are a lot of different parties here that dip into this industry in various ways. So the idea is to understand that as a retail trader, understand where your place is, understand kind of essentially what the game is, how it's played, and who you can trust, where you should put your trust in, and to what extent, and how you navigate the situation. Because a lot of these things, yes, there are conflicts of interest, but a lot of them are necessary evils, because we need the tools. Like the broker, for instance, there's a lot of conflicts of interest on the brokerage side, but we also need them to access the market. So we just need to understand how they run their business, what their incentives are, and we need to steer clear of some of the things that they can potentially do that may be harmful to us, and just avoid those types of things. So other than that, let's just get in. I feel like the best thing for this lesson is just to get into it and start diving through it. So to start off, in order to understand conflicts of interest in trading, you need to follow the money. We need to figure out who's making the money, how they make their money, and then we can figure out what their incentives are. Everyone that is in this business, especially in trading overall, this is a very much capitalistic for-profit business. That is what everyone is here to do in a very pure form. It is certainly not a charity. So, there aren't any free lunches in this business. There might be disguised as free lunches, especially on the brokerage side, but there aren't. You're getting free tools. There typically is a catch to some degree, and that again is on different levels. So we're going to explore some of that as well. So to start off here, we got our pyramid here of our pyramid of power. So we're going to first start off by naming who are the players, and these are the main players that we need to be overall concerned with and understand. Okay, so who are the players in the game of trading? First one is going to be us, essentially, or mostly, I would assume everyone that's here or everyone that's watching these videos. Retail traders, passive investors. These are regular people that trade from their own funded accounts through a retail broker. The profit source, what their intention is to generate personal returns from their own trading and investments. So that is the first person we're going to talk about that is participating in this ecosystem, okay? The next one is going to be the retail brokerages and the introducing brokers, okay? These are marketing entities that specifically target and solicit regular individuals to get involved in the market and deposit funds via margin. So that's when you're putting up margin and you're able to get leverage on that margin. The profit source is mostly commission-based profits, some A-book profits for lesser regulated brokers and IBs. So we're going to get deeper into that. So the broker is, at the end of the day, a sales organization. They also have technology, a lot of them. But at the end of the day, they're a sales organization because their main money is made by taking a retail investor, someone like you, me, saying our brokerage is the best. Please deposit your funds with us. And if you do that, we're going to give you X, Y, and Z perks. We're going to give you a really cool looking dealing platform with a lot of lights that flash. We're going to give you that. So you're going to feel really cool when you have all these charts up on your screen. That's going to be our platform. You get to use that free when you deposit with us, okay? They have other perks. They give you different discounts. They give you... There's a number of different perks as far as depositing your money into the brokerage. You may notice if you go to Las Vegas, you go to any of these casinos, if you walk around, it won't take you long to figure out that if you join their players club, there's people that approach you, you get perks, right? You earn points, you get this stuff. Very similar to retail brokerages, okay? They want to attract you to spend money inside of their brokerage ecosystem because they're going to make commission. If they're a lesser regulated brokerage, they're going to make OTC gain, which we're going to talk about deeper, which is essentially them taking your deposit and sticking it in their pocket. So we'll get into that deeper. But anyway, they are a marketing and sales business. You might be thinking, well, what about the funds? What about like the leverage? If I put in my $10,000 or my $50,000 of my money, I get leverage on that. Where does that come from? That's what we're going to talk about next. So next is going to be investment banks and market makers. So starting with investment banks, these entities provide a line of credit to retail brokers to supply leverage for market execution. So these are the lesser known people in the background that are actually, when you're going to live market, they're putting up the money. They extend a line of credit to the brokerage. So it's not the brokerage's money. The brokerage usually needs to put up their own margin to secure, $250 million, $250 million of margin money for the broker to use. So they have that there. And so everyone's kind of leveraging their money up the ladder, right? So going to profit source of investment banks, profits mostly based on collecting annualized interest from credit lines extended to brokers and other entities, and then also profits from market making activities. The investment banks and the market makers are usually under the same exact roof, different departments. Market makers provide liquidity and trade matching services to brokers. The hedge funds and other organizations that execute trades. So market makers are the ones matching trades. Your trade goes to live market. That's going to go to a market making desk. That market making desk, either via fast algorithmic trading that matches buyers and sellers on the lesser quantities of orders, or lesser size, I should say. Those usually just go to an automatic machine matching system. The bigger stuff usually still goes to the desk where you actually need to call it in and you need to make a trade with the dealing desk. So they're going to provide liquidity for all these live market trades. Pretty much everything, like you could think of like the market maker is kind of the referee or the gatekeeper of real market access, actually going in and making a trade, okay? And that's important to understand that because not all trades go to the live market, which we're going to talk about in a second. So, we'll get into that in a minute. So profit source for market makers is profits from spread between the bid and the ask. They are also acting in a trading capacity, meaning if you want to buy, they're going to take that inventory from you and they're going to match it with someone at a lower price or higher price. It's depending on whether you're going to buy or sell, but they're making that little bit of spread in the middle. And we can usually see that represented between the bid and the ask line. It's a very small spread typically on the market maker side, but remember that they're getting all the transactions. So they're making a tiny, tiny slice of tons and tons and tons of volume. So it ends up becoming very significant for them. So they got profits from spread, and then they also have profits from proprietary trading activity. The market maker has to trade in a proprietary stance to manage their book of business overall, and that's basically going to wind down to how much net long and net short positions the market maker is balancing. If the market maker gets too out of balance, meaning they've taken on too much long inventory or too much short inventory. Let's say they've taken on too much short inventory because they've been matching too many people that want to buy. But the market legitimately has a lot of demand and it's going to go up on the institutional level. They are now net short overall in their portfolio. they need to proprietarily trade out of those positions. So they will look for ways to dump that. And that's where we see reactions at fair market value, things on the actual ATS software. We see that price will pull away from value, dip back down to value very quickly, and then reject. That is the market makers likely balancing their portfolio and getting rid of the positions they don't want to have, because the market legitimately is going in a direction where if it keeps going and they don't dump those positions, they're going to lose money. So because they're making a market, naturally they're going to get overly net long or overly net short, and their proprietary trading, just to kind of package this up here, this idea is to manage that, but also too, this becomes a money-making activity as well, because they can also manipulate the market and use that to fill their book with good proprietary trading positions that they're going to hold on to much past the general matching of buyers and sellers. Really, at the end of the day, the market maker is the insider. They have the best information. They have the best knowledge out of everyone. They have the fastest information. They're looking at the best representation of real-time order flow. And they can also see future order flow because they can see all the pending stops and limits in the market. They can see what's sitting there. So they know they have the best inside information you can get without technically cheating. So we definitely want to be very interested in how they run their business. So we got market makers, and then past them we have the interbank brokers. These are the big boys. These are the really shadowy characters in the general finance hierarchy. Interbank brokers provide liquidity to world banks, market makers, and institutions to facilitate large international transactions in Forex. Profit source from spread between the bid and ask, profits from proprietary trading as well. So these are the even higher market makers. These are the ones when you want to place a really, really big order or accumulate a lot of inventory. These are the guys that negotiate the deals between the banks. So very, very high up there when it comes to trade matching. We less need to know what these guys are doing. We more need to focus on the lower level market maker and how they trade, because those are the ones that are really affecting the stuff that we're doing. The really big macro trends that go for months and months and months are going to be on the interbank broker level. These are not people that are just trying to dip in and dip out. These are people that are building massive positions because they typically know something, or they're controlling something big. So that's kind of the hierarchy of the people that are involved in finance, as far as from the retail level to the biggest level of market maker. This is what's known. Not to get too conspiratorial, but past that, we have central banks, which are known as well. And then we have the private entities that own the central banks. A lot of people don't actually still know that the central banks are privately owned organizations. They think it's a government entity. It's not. They're literally owned by people. And those people lend money to the governments through the central bank. And that is one way that they control things and manipulate things and all that. So that's a whole nother topic. But this is really the hierarchy of control and power. And you notice that we're kind of at the bottom. The good news is, though, is that if you understand the structure, you understand the hierarchy, you understand the incentives, truly, you understand how this business works, then you can take advantage of understanding how they need to do business, and you can operate without any of the restrictions that they have. So you can use this knowledge to really fly under the radar. So it's actually, you have kind of like the lowest level of control, but you also have kind of the best position to exist if you use this knowledge to your advantage. So, okay, so let's go. So now let's talk about the 90-90-90 rule. So the 90-90-90 rule is an industry-wide standard, especially on the brokerage end. They all know this. And they base their business model off of this statistic, which is basically 90% of traders are going to lose 90% of their account within 90 days. So when they are looking at their overall risk models, especially on the brokerage side, the market making side, all that, this is more on the brokerage side though, I should say. They know that every single person that they get to deposit money with them, 90% of them are going to lose that money, and they're going to realize those losses within 90, or they're going to lose 90% of their account within 90 days. So that plays into the OTC side, which we'll talk about in a second. So I already pretty much said that. Yeah. Industry-wide standard metric. In response to this predictability, they have created contracts for difference. So this is a big profit source of lesser regulated brokerages. The ones that are regulated find ways to still participate in this business because it is so lucrative. Okay. Contracts for difference are, let's just go through it. Stocks, indices, crypto, precious metals traded through your brokerage with high leverage. So we use, at this point, we're using Think Markets with the platform. You'll notice that there are Forex pairs in there. You'll notice that there are metals like gold, silver. You'll notice that there's US 30, which is Dow Jones, S&P 500. You have these indexes. Okay, those are all CFD contracts. And if you open the symbol, you look at the details of it, you can see right here, it says profit calculation mode, CFD. That's the contracts for difference. What this basically means is that you do not own the underlying asset. You're not actually owning, if it's a stock, it's a CFD. If it's an indice, it's a CFD. If it's a metal, it's a CFD through MetaTrader. We're talking about, because that's going to be most people's experience with this. You're not owning that metal. You don't own, there's no certificates that say you own that amount of gold that you bought. There's no certificate saying you own a piece of the Dow Jones US 30. All you have done is made an over-the-counter agreement with your broker. Okay? That's what's happened here. And whether you win or lose, they will either deduct or add the difference in balance to your account, the broker. Okay? These instruments are primarily used for over-the-counter gain. That's what OTC means, over-the-counter gain. So essentially what this means is that when you trade a CFD, if you win, you're taking money out of the broker's pocket. Where does that money come from? Other people's deposits. Okay? So you are in good faith expecting that that broker is going to put the money, the difference, the contract, it's a contract for the difference of the trade. They're going to deposit that difference into your account. If you lose, they are going to take that money out of your account and put it in their account. And that is it. It's a simple thing. But there's other implications with this, though, like solvency. Is the broker going to be around to pay you if you do have a massive winning trade? Because these are extremely high leveraged products, which we'll talk about more in a second here. So let's talk about retail brokers' revenue streams. The 4 different streams for a retail broker, the main streams are going to be spread. They're going to mark up the spread. Some of them aren't even really marking up the spread anymore. So, but that's typically a revenue stream in there. Commissions, fees for processing trades. Sometimes people will have a round trip commission. It's just a flat fixed fee. That'll be in there. These models vary from broker to broker. They have finance turn. If you notice that if you're in a trade for usually over 24 hours, there'll be a turn cost in there on a lot of brokers where they charge you finance charges for using the margin over the course of rolling day to day. That is representative of sometimes the margin that you are using that is from the investment bank. So remember, we talked about the investment bank, one of their revenue streams, which we'll talk about again here in a second, is extending the line of credit to the broker. The broker is paying yearly interest on that line of credit. And so this is a way for them to transfer that cost to the traders that are tying up money. OTC gain is taking the other side of client trades. By far the most lucrative income stream of the broker, if they can participate in this business. So the conflicts of interest with retail brokers. So the retail broker provides on-demand liquidity to the retail trader, and typically a trading platform and data. You're also getting a data feed, all free for depositing the margin, or supposedly free. But remember I said there's no free lunches in this business. Okay? They're taking the money some other way. The majority of the broker's value to the retail trader stops here. You have data coming into your platform. You have a way to buy and sell pretty much on demand, which is very valuable. Not going to discount that. We need these things. We're happy to have them. So we got to go towards incentives, though, now. Trade volume plus trade frequency equals profits for them and losses for you. And you got to think about the brokers who advertise zero commission, instant execution, low spreads. What is their main profit source? Okay. Things to think about real quick here. If they're not taking any commissions or markups, okay, they're basically passing to you the market makers' raw spreads, right? How are they making money? Well, there's not a whole lot of money to be made there, right? So let's take that off the board. Zero commissions. They're not charging you a round trip to get in, like a fixed, $10 commission or whatever it is. That's gone. So, okay, they're not making money there. Instant execution. How can you guarantee instant execution? If the order needs to be routed to a market maker for matching, can that happen very quickly? Yes, absolutely, it could happen very quickly. But how can you guarantee instant execution? How you can guarantee it is if it's demo money, essentially, if it's like a demo account. There's always going to be a match, because when it's an OTC trade, there's no matching that needs to happen. The broker is already guaranteeing the liquidity. They're taking all trades in-house. So the matching just happens. You want to be in the trade, you're in the trade. And the broker's just waiting to see whether you made the right decision or not. And then they deposit the difference. So you can give instant execution, zero slippage, because there's no matching that needs to happen on an exchange somewhere. Just the broker. You're making the agreement with the broker. I'm going to win or lose, and the broker's going to deposit the difference into your account or take it away. So no need for anything past that, right? Where's their main profit source? The main profit source is going to be in taking the deposits and trying to keep those as their OTC gain. They want you to trade as much CFDs as possible. And they want you to trade a lot, and they want you to trade very frequently and at very high volume. This goes, if you look at the theme of all the things we talk about in this lesson, how does this play into the emotions of the market, the pain and pleasure side? The narrative that the broker wants to push to you is to trade big, make a lot of money, live the trader's dream, right? They want to give you highly leveraged things to do that, to give you that excitement, to make you feel like you're doing that. These are all tools to lure you in, to get you to do what's actually the wrong behavior. Why? The higher you trade, they would love nothing more than for you to deposit $5,000, $10,000, $25,000 in an account, go to US 30, amp up your position sizing like crazy, and go for one big trade. I'm either going to win it all or I'm going to lose it all. They would love nothing more than you to do that, because it's almost a guarantee that they're going to take your 25K and put it in their pocket. And even if you make the money, let's say that you do have a few big winning trades, what happens? Even when you're out of the market, if you're growing an account, overall you feel good. And as you're growing that account, you have more margin to trade even bigger, right? Are you going to withdraw the money? A lot of people don't. They don't take the money out. So you're still in a pleasure state as you're growing that account by leaps and bounds for the moment. But the broker knows that now they really got you hooked. And they know it's just a matter of time before you make the wrong decision, you get into a massive spin cycle, and flush that account right down the toilet. And that toilet leads to their bank account, right? They know that they need to keep you there. What's this like? What's the same thing? It's just like Vegas, just like the casino. The casino does not want to see you come in, put down a huge amount of money on one hand, win, and walk out. What do? If you win big, they go, we see it in movies, all this stuff. Again, I'm not a big gambler, but I know enough about how this industry works, is like they know that if you make a bunch of money, what are they going to do? They're going to throw perks at you. Let us give you a room. Stay here on us. Here's tickets to the buffet. They start treating you like a king, right? Because they want you to stay there, because they know that the longer you stay in that hotel, in that casino, there's a high likelihood you're going to take those winnings and feed them back in. They want to get their money back. So it's cheaper for them to give you a suite, to give you the buffet tickets, to give you more stuff, make you feel like a real big winner at their location so they can have a chance to get their money back. Same thing with the brokerage. It is all the same type of mentality. And so I know I'm spending a lot on the brokerage side of this right now. And it's because this is really where, as a retail trader on this level, this is really where you're going to end up dealing with a lot of the games that are played and a lot of the things that can lure you into this business and eventually cause you to lose your money. So this is where you really need to pay attention. The rest of the stuff is all kind of necessary evil in the background. But this is right here, by understanding the narrative that they want you to believe and understanding what their incentives are, you can use their tools, but you can operate outside of the grasp of the tactics they use to take your money from you. So just want to be clear on that. Let's go to the OTC gain breakdown real quick. So this is generally how this works. A broker is going to have an A book of business, and they're going to have a B book of business. In the A book of business, you have losing traders, which is essentially the 95% rule. 95% are going to lose their money, right, overall. So 90% are going to lose it very quickly within 3 months. 95% are going to lose it overall. Then you got 5% that are generally start at break even, and then up to the 1 and 2% that actually make the majority of the money. So those are the two sides of the book of business when it comes to OTC gain. So on the A book side, the OTC process looks like this. All trades are kept in-house. There's no hedge. Let's put it this way. When you make a trade, if you're an A book trader and you make a trade, the broker is going to automatically say anything that guy or girl, anything they do, put them in the market for that CFD contract. We're good on that. We're going to take anything that they want to trade. We'll do the opposite. We'll take the opposite side of that trade. No hedging, no nothing, no insurance on it, just totally naked. Okay, the result, the broker makes a spread, commission, finance turn, if they have those things in place. But more importantly, they're making the complete OTC gain on that trade. And if the trader wins, they look at it as a temporary loan because you actually haven't gotten any money. They've literally just changed the balance in your account. No skin off their back, right? They just need to keep you in the house. They need to keep you playing. Okay? So that's it. They know I just need to keep that A-book trader interacting with the market and we'll eventually recoup our money, plus everything they deposited, which is their real profit. Client loses full trade difference if they lose a trade, right? The B-book business, these are the winning traders. Everybody, for the most part, starts in the A-book business because they assume that, again, the 90-90-90 rule, they can onboard 100 traders that deposit with them. 90% of those, they're going to keep all that money. 90% of what's deposited, or 90% of the traders that they deposited, right? They're going to keep all that. They know they can build their business model around that, their risk parameters, everything. So they're really looking at what are how many deposits have we had this day, this week, this month, this year. That's their business. So when it comes to the winning traders, the 5%, they're going to have to lose some money to figure out who's an actual winning trader, right? So they're going to take a loss on some of these guys. And when they know like someone has had a consistent run, especially if they've taken deposits out, like, okay, look, we need to hedge this person. We don't want to take the side of this person. So they're going to you're kind of going on there like, hey, fine. Like, we're going to still obviously service this business, but it's not a profitable business. Honestly, it's a little annoying. Why is it annoying? Why are the 5% guys annoying to the broker? Okay. Oh, let's go back to this though. The OTC process, all trades are kept in-house and they have to hedge with the real underlying asset. So what does that mean? That means that they're still taking your trade in-house, but then they are placing an opposite trade, or basically the same trade you're doing in the actual market. That's going to the actual market. What money are they doing that with? They are doing that with the margin, the credit extended to them from the investment bank. They have to take that money and go invest it and let it set in the market to hedge for their 5% winning B-book traders. Why is this annoying? Number one, they're not making any money off this guy. Number two, it's tying up their investment bank money. You're essentially just existing in their sphere and taking up resources. But they'll do that. They'll deal with you because they still have the other 95% that they're going to keep all their deposits. So essentially, again, you're just annoying. You're taking up resources. You're not worth any money to them, but that's the deal. They have to take your business so they can get the others that they do make a ton of money on. So, and with this, obviously, you make the full trade difference. So you are winning. So, ideally, we want to be in the B-book business for sure, because that means that we're making money. But understand, this is so that you can understand how the business works behind the scenes, and that if you are a winning trader, you are an annoying trader. Unless it's just a standard U.S. regulated broker on the front end, typically you're paying a higher spread. You notice like why if you go to Awanda, you go to Forex.com here in the States, or a regulated broker, you are paying finance turn. You are paying a higher spread. You are paying sometimes a commission. Why? Because it's much harder for them to participate in the OTC gain because it's illegal. CFDs are illegal in the United States. It's not hard to see why. But that doesn't stop these brokers. A lot of them will own these other offshore brokers roundabout so that they can participate. They're so desperate to participate in this business because it's so lucrative. Who wouldn't want to just keep all the deposits, right? So anyway, I just want to make you guys aware. This is what's happening in the background. This is where the incentives lie, and this is where the conflicts of interest lie, which is all good. We understand that that's the deal, but we need to be able to operate in this system, but not fall trap to what they want you to do. All right, introducing brokers. We're going to go through this stuff a little bit faster here. Introducing brokers' revenue streams, which is going to be a percentage of the spread, commissions, finance turn, OTC gain of the brokers, depending on which revenue streams the brokers are able to participate in. Conflicts of interest with introducing brokers and online educators. IBs are the sales force of the retail broker. The goal of the IB is to persuade you to deposit as much as possible, trade as frequently as possible, in the biggest size possible. Most will use just about any tactic to lure you into the trader's lifestyle dream, and the new hack is owning your own broker. So that's a big one right now. Also, too, another big thing is owning a prop firm. And I know that we do this as well. We are tapped into this same infrastructure. A lot of people are opening their own prop firm. They're saying this is our money, and it's not most of every time. But they're using all this stuff to draw people in. And I'm not saying the prop firms are a great thing. I think it's the greatest thing that has happened to this business. But the people that really are playing the prop firm game are not telling you. They're not telling you a way to, or showing you a way to interact with that to use the resources in a healthy way. It's just another way to make you feel that you can accelerate and go faster and faster and trade bigger faster. And it's another way to extract money from your pocket via evaluation fees. Okay? So they're using all these things. They want to open their own brokerage. They want to open their own prop firms as a way to continually siphon money from you and make money from the narrative. What's the narrative? The trader's lifestyle dream. Let's trade on the beach from a laptop. It's so easy. Look at how I could do this. I made $50,000 this morning just sitting on the beach. Look at it. It's a real account. It's a live account. Okay, go research that broker. Go research what broker they're showing there. It's probably some shady broker from the Cayman Islands or some, very low regulated place. And if you really dig, they probably own a percentage of the broker. Or they're a high-level IB. They're a high-level introducing broker. So you'll notice that through all their marketing material or their YouTube content or whatever, it's like, hey, go to our broker down here. Here's a link. That's their thing. The broker will give the influencers accounts that say they're real. They will retroactively put trades in that never actually took place in the moment. They will play all these games to sell you the trader's lifestyle dream. This becomes very damaging, especially it's getting crazy, because what it does is the people that legitimately want to put in the hard work to do this business long term see these guys running around in their rented cars and all their showing off this lifestyle, and it makes you feel, when you're doing everything you should be doing, it makes you feel like you are not doing good. It makes you feel like you're behind. Like, how could this guy that's wearing, Richard Mille watches and, a $50,000 metal chain, gold chain around his neck, driving Lambos, like, how could this guy be so good and I can't do this? It's because they're not doing it. They are operating, they're an actor in the system. They're an actor for the broker. They're an actor for the prop firm. They have control of the back-end systems, either to a full degree or to a lesser degree, or they're in cahoots with the system, because it all plays back into the OTC gain. You'll never see these guys IBing or repping for Forex.com. There are still some, but they're always pushing you to some shady offshore broker because there's a back-end deal that's made there, a very lucrative one. And it's all an act most of the time. I can't guarantee because I don't, but I can tell you right now, I've been in this business a long time. I know I've been offered these things personally. The only thing we have never ever taken an IB contract ever, not once. I've made zero commission from referring to a broker in 12 years. We have talked about different brokers because the people are like, what do you recommend? So we'll tell them, well, you could look at this. We always want to make it their decision, though. I want you to do your research. Okay, but we never have taken that conflict of interest, and it's been tempting. The only thing we've ever done is the prop firm. And the only reason we did the prop firm, because I feel that the net positive of what is available there is good for traders to be able to tap into that extra earning power. Because I feel like if they use it the correct way, they can use the extra money to limit their risk more. And so they can still get a meaningful income from their trading. That's it. That's the only reason we tapped into that business. But the way that we're going to sell it to you is we don't want you to buy evaluations. It is literally a tool so you can take as least amount of valuations, hopefully as possible, to get the tools you need to make the money you need to make without having to overly risk money that you don't have personally. So yes, we are using the infrastructure, but the way that we are selling it is completely different. And so if you're going to use other prop firms, ask again, what are their incentives? Our incentives here at ATS we do have things to sell, but our goal is to collect our subscription and build a big software business. That's what we do on this side of the business. We want you to be here. We're not getting rich at $150 a pop. It becomes very significant to build a large user base that is loyal and that stays for a long time. So as an organization, our incentives are to get you to stay in this game for a really long time and have the resources that you need to do that. That is our incentive. We're talking about following the money here. That's it. Build a really, really solid software side of this business. Find some great traders. We want to do our own prop firm later on. We're not at that point now. And build that infrastructure and sharing the revenue streams. So we'd like to do that later on. That's a future plan. But right now, our goal is to tell you guys the truth of this business, connect you with the tools that are actually legitimately going to help you succeed so that you have longevity. And our selfish reason is so that you stay subscribed to our tools for a really, really long time and you find them useful. We still want to make them good. That's it. It stops there. Can we make a lot more money if we played the game quickly? Yeah, a heck of a lot more. But obviously you guys know, and I think that's why a lot of you guys are here, is like you understand where our stance is on this stuff. So anyway, I know we spent a lot of time on that, but this is, again, I guess the brokerage and the introducing brokers. The introducing brokers are just they're more sales guys for the broker. It's all selling you. It's all selling you the dream. This is where you need to spend most of your time understanding how the game is played in these areas. Okay, so let's move on from there. We'll go to the market makers' main revenue streams. Spread and proprietary trading, two main revenue streams for the market maker. Conflicts of interest with market makers. Market makers process all transactions. Market makers trade their own account. Market makers control the flow of supply. Whoever controls the supply controls the market, and this means that they can temporarily suppress or inflate prices at will. Okay, market makers, as I said earlier, they are the biggest insider that isn't illegal. They're the biggest insider trader out there because they see the most real-time data. They see the real order flow. They see the pending order flow in the form of stop losses and limit orders that are just sitting in the profit or sitting in the market, not triggered yet. They see where all those things are. They know exactly what price can be pushed to, what they can get away with as far as manipulating the market. If they want to dump supply into the market, they know exactly how much they could do. They know exactly what price they could push it to because they know where the pending demand is, that it is already there. They can coordinate very calculated efforts to shape market beliefs and chart patterns in a way that serves them to the highest degree. And they could do it all on the level. Completely legal. So it makes a lot of sense that we understand how their business works and what their incentives are. And again, their incentives is to collect a lot of spread, but also their incentives are, how can I be properly weighted in their own portfolios, ideally their positive selection portfolio? How can I proprietarily trade the market, manipulate if necessary, to weight my portfolio in a positive direction so that I can make the big money trading? The biggest money they're going to make is in proprietary trading. Spread is just bread and butter. They love to have a lot of spread coming in, a lot of willing buyers and sellers. That's just money off the top. They're just siphoning in. But their big money is made when they can put on those big positions and accumulate enough in that positive selection portfolio in the overall flow of the bigger time frame money is really where it comes down. And that's why we look at the bigger time frame so seriously. There's always the time that's needed to scale in and scale out. It's a huge part of institutional trading. It's not always just in the moment like a retail trader. They're moving a lot of money. So they're going to always try to typically they're going to try to manage their positive selection portfolio in the direction of the higher time frame money. So it makes sense for us to also look at it from that perspective as well, right? So another thing too that is noteworthy about this is the supply. Because demand is really about promotion. Demand is about excitement. When we talk about demand, we're talking about buying power in the market. Demand is a little less predictable. You can say if you're promoting a stock and some influential person, like let's take an Elon Musk, he goes on Twitter or X now, right? Or on the news and says, yeah, I like XYZ stock. You know, that stock's almost certainly going to start to go up immediately after he says that, because he's an influential character. How much is it going to go up? No one really knows. That's a promotion. That controls demand. Is how much real hype is in the market. Supply is another thing, though. Supply can be measured because the demand that's coming into the market, if let's say you have a lot of people trying to buy, then the market makers can control how much they are willing to sell. The sell is the supply that's available, that inventory. They are in charge of how much they want to put into the market. They can flood the market with supply. When you get too much supply, what happens to prices? They go down. They can flood that. So even if there is a level of demand, they can overpower that and let the market go down. Now, let's say that there is a lot of demand in the market. The market makers can dump supply into that demand, whereas if it were left to be totally organic, then the price naturally would go up because more people want to buy. But the market maker keeps the price sideways because they are matching all those trades. They are artificially holding the market in a sideways pattern, even though that's not reflective of the mass market opinion. They have the control to do that. No one else does. They can take a legitimate will of the market, providing it's not overly strong. There is a realm where this can happen. We saw that with the GameStop thing. The GameStop thing had so much buying demand out of nowhere, they weren't prepared for it, and they got hosed. The banks did. That's why everyone was celebrating it. But there is, especially in Forex, there's a range where they can control these things and they can create patterns. They can do all these things because they can essentially hold the market sideways. They can take what is legitimate buying demand, make it feel like there's nothing there. What kind of power, what kind of chart patterns can you form with that kind of power? A lot. You could do quite a bit by controlling supply. So that's another thing that's definitely worth studying. So, all right, let's move on. So conflicts of interest in market making. Market makers take on the responsibility of matching buyers and sellers. All orders placed and pending are sent to a market maker for execution. The information market makers get from processing everyone's orders gives them a level and depth of insight into the market liquidity and intent that others do not have. So I think we've covered that pretty good. So here's a quick example. We're going to go over real briefly of this process. Market makers focus on efficiently matching buyers with sellers in sideways markets. This is where they're getting that base income stream of spread. They're getting a lot of buying and selling activity. They're getting the difference between the bid and the ask, and that is just the money that they're siphoning in off the top. Okay, as the market breaks out of that, let's say that the demand becomes pretty strong. The market makers they're like, we're not going to keep it in this sideways market, whether it's organic or not. They're letting it come out of this sideways movement. Okay. Price breaks out long. Buyer sentiment is revealed to the market makers. More buyers rush in. They start to see, okay, there is a lot of strength in buying right now. remember, traders always favor confirmation over trade placement. Typically, they want to see the breakout. I see the breakout. I see it happening. Now I'm in. Now I have faith in that move. Okay, that is used against traders, and this is a very pure example of how that is. Market makers see, okay, there's traders coming into this market. Where are the stop losses coming into the market? They're typically going to come in below very localized, in this situation, lows. So we see the stop loss placement there. Market makers, since they control supply, if it's possible, they can flood the market with supply at that high and drive price down. They can swamp the buying demand and artificially move prices down because they know there is enough profit to be made by harvesting the stop losses at the bottom. What does this start to look like? Multi-leg expansion, right? We have our first leg up, our second leg down. This is the master pattern. This is the beginning of it. This is why the master pattern methodology takes all the things that we're talking about into consideration, and it puts it into one single framework of contraction, expansion, trend. So if you only learn the pattern, you don't need, what we're talking about is how the watch works. This is everything behind the scenes, all the incentives, all the reason why they do what they do. We're really dialing into what all that stuff is, right? We're really digging that up. But at the end of the day, if you just know the master pattern, you're naturally trading in line with these best principles, these best practices, right? So they know there's a profit to be made, and this is still within their range of control. They have enough control of supply to artificially manipulate the price down because they've calculated that there's profit to be made. So they do that. They're able to dump their negative selection portfolio down at these prices because now you're getting traders that are rushing in to sell the market. You're getting traders that are getting stopped out. And the other side of all that is buy positions for the market maker. They can then take all those in-house, fill their inventory, and then the market, they let it organically move up. Or they can cut supply to kick it off because they know that there's still enough buying demand, as demonstrated by the first breakout, that traders are still willing to rush in. All pre-calculated. They're not going to wing it. If you guys were on the last webinar, we talked about what is a trader. A trader is a guy that accumulates, they buy something in expectation of selling it later on. The best traders already have a buyer at a higher price. Market makers are still traders. They already knew there was a buyer at a higher price because they assessed it in the first place. Where did they assess it? At that first breakout. It was a test. Are there buyers at this price? Yep. Okay, now let's go back and get something to sell them. I don't want to sell it to them at that price. So they test the market. Let's test the water. Yep, it's there. They go back, get the thing that those people want to buy, come back and sell it to them. Nothing is left to chance if it doesn't have to be. The only thing that goes outside of this normal business of buying and selling for profit is black swan events. Tsunamis, earthquakes, COVIDs, which may or may not have been somewhat planned. But it's another thing, right? Black swan events are what messes this up. So we always got to be on the lookout for those. Always got to be on the lookout. Because that's where you think like I'm buying under value, I'm selling above value, and something big happens. So always got to have a contingency plan. That's why we can't trade naked with no stops. But outside of that, it is the normal algorithm of buying and selling. It's a normal thing. Nothing changes here. This model goes over and over and over and over again. So it is our job as traders to stay attached to that model. Follow the money, understand the incentives, understand the business. What does the business look like on a chart? It looks like the three market phases. It looks like the master pattern. This is the embodiment of how the business is carried out. So if this pattern isn't present, or it's not present to a degree that you understand, can you truly say you're participating in this business effectively to the best level if you can't see it clearly yourself? So that should be another thing you should ask yourself before I get in a trade. Can I clearly see the business model? Can I see where I'm going to participate in that business effectively? That's really becomes your main job. Okay, so the market goes up. Market makers take the sell pressure off price. Up move resumes as originally intended. Traders jump back in long. Market makers take profits, and so on and so forth. And that's how it goes round and round and round. So what's the takeaway? Brokers and market makers are a necessary evil. We need them. We are not going to go start our own brokerage for direct market access individually. Wouldn't make a lot of sense. So we have to operate inside those structures. The difference is we just need to understand how they operate. And when they offer you the free stuff, they offer you the higher leverage, they offer you the evaluation, get all that money, trade it. We're going to look at that differently. We're going to say, thank you. I'll take the dealing platform. I'll take the free data stream. I will certainly take the prop firm funding, but when I take that evaluation, I'm not going to be one of those guys that's going to be buying another one tomorrow. I'm going to have that evaluation for probably 3 to 6 months. I'm going to use the leverage I get from that tool for my long-term benefit, not your short-term gain, Mr. Broker, Mr. Prop Trader, prop firm guy. This is for me to use, not for your narrative. That's the difference of how you need to approach these things. Understand the game you're playing. Understand how to exist long-term in that structure. And use the tools. You're going to be annoying to everyone that operates in the narrative. But so what? The reason you're not annoying to us because we don't, from this side of the business, we don't make our money that way. We make tools. And our incentives are the same as yours. Survival. Survival, long-term profitability. You need to be aware of the tricks and snares used by brokers and market makers. You need to choose your broker wisely and make stability and regulation a large factor in your decision. We do get a lot of questions. Right now we're using Think Markets. All that stuff is not our choice as far as the prop firm goes. We are utilizing that structure. But it is not our choice which broker to use. These are the brokers that are friendly to the prop firm structure. Will they be around forever? Will it work perfectly? That is ultimately a risk that we are all taking with those things. And you got to assess it as an individual. Is the upside, if I can secure prop funding from one of these, even if it gets outregulated someday, they might outregulate all of us. Can I secure this for a long enough time to establish my own funds? That's really the ultimate, is to operate with your own funds, your own infrastructure. But can I utilize these tools, these resources, while there's no problem doing it? Everything's holding together just fine. But can I do that for long enough to establish my own operating infrastructure? Because again, that is the ultimate place you want to be. That's where you have the most safety and control. Okay. When you do get there, and again, I don't see the prop firm business going anywhere. We don't have anything on our radar, but it is always a risk for you, for us, for everyone. Regulation comes in, likes to sweep these kinds of things clean every once in a while. I thought CFDs were going to be outregulated 8-9 years ago. They're still here. I thought it was going to be more of a worldwide initiative. So, I guess it just depends on the lobbying for the rules and who's making the money on the back end, right? So, anyway, these things exist. I would definitely encourage you guys to take advantage of them. There's no way where you're going to get better leverage for your money and different things than prop firm funding. I think it's great, but you need to have it as your long-term perspective, to establish your own safety net. And when you do that, you're still going to need to deal with a broker. So how should you go about doing that? You want to make stability and regulation a large factor. That's where you might make a lot of money with the prop firm structure. A lot of them are using offshore brokers. That's fine. Take that money, put it in it, pay some commission. Pay the commission. The reason you're paying it is for the extra stability, the extra regulation. It's okay. Understand now what the difference is. If you're paying a little more, it's probably because you're getting extra assurances. You're getting some insurance on the funds you're depositing in those accounts, especially if it's a significant amount of money. No one wants to go stick 50 or 100 or a couple $100,000 in a pop-up offshore broker that wasn't there a year ago. It's risky. So as you guys move up in the hierarchy of this thing, you want to go towards those safety nets because they're going to protect you in the long run, no matter what. So, and even I shouldn't say no matter what, even those are not 100% safe, but life is risky. This is the risk that we have to mitigate through in a smart way. So, you need to be aware of how the market makers do business, watch their activity, and operate outside their grasp. I think we went through pretty thorough on that as well. So this is all this stuff put together. We talk about conflicts of interest in this lesson. Does everyone here kind of see how following the money, understanding how this translates into actually how you approach trading, how the patterns are formed? The amount of risk that you take, the amount of leverage that you take from the broker. Remember the leverage, the 100 to 1, 200 to 1, 5. I've seen 1,000 to 1 leverage. That is a marketing tool. And it's a tool to get you to do what? To participate in the mainstream narrative, to do things that feel good but are bad for you. By understanding this knowledge now, you operate outside of all that. You take what you need, but you understand the truth of the matter is if I want to do this long term, I can't indulge in these things. I can't indulge in everything that they're giving me. And I got to ignore the guy on social media that's making me feel bad about not doing about approaching the market in a conservative way. That guy's not going to be there eventually. But you will be, because you're doing best practices, you have a long-term mindset, and you are abstaining from the practices and the things that are trying to be sold to you that you know are ultimately going to lead to you not being here. And that's it. And that's the reason why we want to know this stuff. And it took a long time to learn all this stuff. So hopefully you guys like it in this format, and hopefully it's helpful. So that ends what I have to talk about on that. If you guys have any questions, I'm going to open it up for those right now. All right. Go for it, Bowden.
So thank you very much for, the webinar. The question that I have that just comes into my mind is, like, this game that you described looks like a market chess game, right? And me as a retail trader, like, do I have to change my mindset and my beliefs in order to win long term? Like, stop thinking like a retail trader and start thinking like a market maker by using the framework with planned trades, and like stop this get rich quick fantasy that's sold to me? Like, 'cause obviously something has to change here, and it seems like it's me.
Yeah, I think the biggest thing that the retail traders, the service that we're trying to give people at ATS, I feel like the first thing we could do when someone comes through our doors is teach them how to stop losing money. And so the first thing we could do, that's immediately going to put them a little bit net positive, is we're going to stop the bleeding. We need to teach them how the industry works. And we start by doing that by understanding, okay, this is the pattern behind the scenes. We teach them the master pattern. Why do we teach that? Because it really embodies the overall algorithm of buying and selling that's happening on the inside level. So we start by teaching them that. To answer your question, we got to get them to change their beliefs about how the market works, about the indicators that are used, about all these things that are really designed, a lot of them, to just keep them playing the game and going on the mainstream narrative. So we need to get rid of that thought process. But more than that, with this lesson, is that we need to teach them really who's making the money, how they make their money, so they could understand it from all angles and operate in that infrastructure. So, yeah, to answer your question, you need to do a full makeover on your beliefs and what you were taught, because 99.9% of the material that you consumed that got you interested in this business is likely pushing the mainstream narrative. And it's a strong narrative, and it's a very enticing narrative. So a lot of it is rewiring and coming to the conclusion for yourself that this is how the business works, and deciding that you want to operate outside of that narrative. So does that answer the question?
Yep. Okay. Thanks.
Thank you. Lewis, let me go ahead and unmute you. Go for it.
Yeah, thanks, Wade, for your insights. Looking back over the past couple of months, it's just a miracle that I actually crossed your path. And because you don't really advertise yourself broadly, but it's absolutely a miracle that I got into contact with you guys. And I would like to congratulate you on your software, because I think it's just absolutely amazing. There's nothing like Trade ATS's software, and if you understand it, and it takes time. It takes screen time to understand that. It's just absolutely wonderful stuff. So I just want to say thank you very much. It's wonderful to be associated with you guys.
I appreciate that, Lewis. We're happy to have you here as part of the FTAP program, and appreciate you showing up to go through this stuff with me. And again, it's not I sympathize with every single person here, because you've all got bit by the trading bug, same way I was bit about 12 years ago. And you guys realize the power of this, but now, I think a lot of you are in what we call the valley of despair. You had uninformed optimism coming into the business. Like, this sounds really great. It looks great. It is great. But now it's like, now you're faced with the truth of how the business works and how difficult it actually is. But by taking this information, now you understand this is a reality of the game that you're playing. And this is the realistic timeframes associated with that. And now you're deciding if you really want to play it. And you guys are here. You've decided that you want to play the game, knowing the truth of how the game is played, understanding how many people are out to actually take your money from you in a bunch of different ways. And you've decided to take that, to take those odds, and you've decided to put some time and effort into learning it. And if there's anybody that's going to make it in this business, it's going to be this group that's here, because you guys are pretty much the inner circle of what we do here. So I got high hopes for everyone that's participating in this, because you've been faced with the awful truth, and you still like it. A lot of people will be like, yeah, I'll go do something else that's maybe a little funner. So, but this is it. It's not glamorous, it's a long grind, and but it is fun. If you really enjoy putting puzzles together, you enjoy that nature of that, then this is definitely for you. It's fun. It's fun that way, as long as you accept what the realities are. Go for it, Bowden. I think you have another one.
There's a quote. There's a quote from Jesse Livermore. I remember reading, and it didn't make sense to me when I first read it, like years ago. But he said that stocks change and people change, right? But human nature doesn't change. It's as old as the hills. And I think really, what we're getting at here right now is human nature and the battle within ourselves. I see it like inside me. And, it's so tempting. It's human nature to want to get things really quickly. And social media sells this get rich quick. And yeah, you see the guy or in the car or in the house or flashing all this stuff. And you want that immediately. And that feeds on human nature. And that's a weakness I think that each of us has to go through, even with like this ATS technology that we have and you've provided. Still in the back of our mind, I have to step back and say, listen, just be aware that this is a game that you're playing, and put that greed emotion aside, and stick with the plan. And that's really the battle. The battle is internal within ourselves.
Yeah, it is by far a mental game, because the market, technically, you could see like from a technical standpoint, what we're doing here is actually not that difficult. We're looking at market trends, and we're essentially looking at value, and we're buying and selling inventory above and below value as a trader to try to resell that inventory back to someone at fair market value, what they've been proven to pay, or better. That's it. But as humans, we complicate that and convolute that so many different ways. Everyone's guilty of it. I'm guilty of it. Everyone is. But if we go back to the basics, we understand how the game is played. We understand that it's longevity that's going to pay over time, not moments of brilliance. It's the longevity, simply being in the game, existing. That's what's going to pay over a long period of time. And using the tools, the prop funding, the softwares, the different things, just use things that genuinely enhance your effectiveness as a trader, and leave the rest out. And then outside of that, it's just your mental stability and your willingness to accept those realities and keep yourself in check. That's it.